This is just a presentation. We're trying this out for our first year, which is we're just going to go through and talk about what the state of the market looks like and where it's headed, right? And it'd be remiss for me to give a conversation without talking about all the technology changes recently. And so I figured one thing that could be really interesting and fun is talking about AI and how it's going to affect a lot of real estate. This presentation was created through AI. There's this app called Tome.app, and it generates slides for presentations. So for example, right now, this first slide was entirely generated through OpenAI, right? You have ChatGPT on the left, and then you have DALL-E doing images on the right. I'm not going to read the whole thing because it's very text heavy. So what I've done is mostly I've cut most of the words down for the presentation portion, and then focused on making the images kind of make sense. But that's kind of the fun part, talking about how AI is going to affect the future of things. Quick intro, I'm Nelson. I found Subtle Asian Real Estate. That's where I know most of y'all from. And I'm also a syndicator, about 35 million assets under management. I'm also a data scientist for Brookfield Asset Management, which is the largest publicly traded real estate firm in the world, as long as some other smaller hedge funds. So when I talk about data, when I talk about the market, I'm speaking from the perspective of them, which hopefully trickles down to us baby investors, right? I think everyone's curious about this, what's coming. They're all batting down the hatches. That's the best way I can describe it. The one word in everyone's mind at the moment is recession. And unfortunately, it seems like the majority of people are preparing for a recession, at least the ones with money. Yes, the stock market's back. Yes, it seems like everything's back to normal, but we are not seeing the worst of it. Largely, there's a few barometers that we can see for why there's going to be a large recession, one of which is the largest yield curve inversion in history. This means short-term bond rates are higher than long-term rates. Typically, this means that long-term rates have to have a higher and higher return to match the volatility people are going to see in the future in terms of returns. Job growth is slowing down, even though it's still growing, of course, more than we want it to. But now we've dropped to 2x instead of 3x. Inflation's been down for the last 6 months. But the two biggest things for landlords to worry about is that rent is starting to flatten in most markets. And even though prices might be coming back up in your market just because of seasonality, they're likely going to keep falling, especially once we pass that summer seasonality and then we start hitting that winter season. I see, and most of us are underwriting for a 5 to 10% drop on average across the US. So everyone be prepped for that. Other things to worry about: rent control. Everyone knows California residential is one of the hardest to deal with, manage. If you are in Pasadena, Richmond, or Santa Monica right now, they've already passed laws in the midterms that cap it to around 3 to 6%, depending on which city you're in, which is even lower than the cap that California gives. Reminder, 3% is half of what inflation is right now. So, you know, it's a tough time to be a California landlord, or even tougher. Florida, they actually passed a rent control measure in Orlando, but the state has a preemptive law that says you can't pass rent control laws. And so that's probably going to get struck down in the state Supreme Court. So if you're a Florida investor, you're going to be good as long as DeSantis remains governor, which it seems like he's been very popular and it's going to stay the course. Nevada, y'all barely missed a midterm fight for rent control. A Republican governor won. If they had taken over, there's a good chance that it likely would have had a rent control bill passed later this year. Minnesota and Maine, Democrats took both House and Senate, but St. Paul, Minnesota has turned around a 2021 ordinance that banned rent, or that pretty much banned any rent raises. It crashed and tanked the new development in the city. So basically, if you ask the city, can I raise rent more than the amount, they're going to let any landlord do it at this point. And so they've kind of turned heel, which is good because, again, rent control doesn't benefit anyone. It ends up creating it artificially caps supply, and as a result, no one really benefits from it. If you're curious why, there's a great Freakonomics episode about how rent control is the best way to hurt everyone involved. So, all right. Another thing to watch for on the horizon, IRS just got an $80 billion budget bump. So there's definitely going to be a chance that they're auditing more people. And if you're a real estate professional, believe it or not, they were already audited at twice the normal rate of the tax-paying population. This means you're probably going to have to pay more in compliance costs to make sure everything's correct. And if you haven't had a CPA yet, get one. If you need one, a lot of us use Tony Hoong, the CPA dude. He's in the SARE group. Feel free to reach out to him. He's very responsive typically. All right. So that's the bad news. How do you get out of it, right? How do you maneuver around it based on what assets that you're going to own or the ones you're going to buy? This is a little bit harder for me to predict ahead of time, but historically, rent has never fallen, right? Residential long-term rent matches inflation. Like from the history of when we started tracking rent in the 1990s, like before this, the Federal Reserve of Economic Data has data dating back to 1900. Rent has only kind of gone up in one direction, right? And it kind of makes sense. Well, rent is shelter, it's food, it's water, it's a commodity that you can't really pass up. And as a result, even though prices of homes can collapse, they've never really collapsed in terms of rent, even during the Great Recession. Unless you were in San Francisco COVID, most places have never seen rent fall by a significant amount, as long as you are taking the average of the whole city. If you're Class A, yes, you typically will see rent decline. And that kind of leads me to my next point. But the benefit of that is that your building holds value better, right? So, for example, I'm taking New York as a metric. They have on the Case-Shiller Home Price Index a low, medium, high range. We're going to count that as high range as A class, low range as C class, right? The high range properties, I don't know if you notice this, but they don't fall as much as the low range prices. But when times are good, those C value buildings, those C class apartment complexes, wherever they are, they bump way faster, right? Because you're starting from a much lower basis point. So when people say, you know, homes in downtown or nice areas appreciate faster, they're correct if they're talking about the absolute dollar value. They're wrong when they're talking about a percentage return on investment. So if anyone tells you that again, go to their face and tell them you're wrong. So likely what's going to happen, though, is whenever the economy goes south, even though people downgrade from Class A to Class B and Class C, those buildings, particularly Class C, is going to see more delinquency, right? So you might have constant demand, but you got to keep churning out tenants who aren't able to pay anymore, right? So there's a much higher risk of that. And so the best way to handle that is get better qualified tenants. That means maybe drop your rent $100, but now you have to have 4 times the income instead of 3 times, which is your normal metric. Or you don't pick people from specific industries that are very cyclical. For example, hospitality. You would rather lean on somebody who's in medicine or et cetera, right? And so we see that after the Great Recession, you know, you might have this ability, if you're already holding on to Class A, now's a great time to buy some cheap Class A buildings because, you know, when the market returns, it's going to hold its value and you have limited risk. It's literally just like bonds or, you know, growth versus blue chip stocks. The lower the value of the building, the higher risk you're going to have. But when times are good, that thing booms way faster than the Class A buildings will on a percentage basis, right? And then this brings me to my other point, which is that the safest considered cities are not actually safer. For example, I get told all the time, if you buy in downtown Class A, New York or San Francisco, that's the safest asset you can ever get. That is not the case, actually. You are more susceptible because you have so much money flowing there that at that same amount of speed, it could probably pull out, right? So your biggest risk isn't that, hey, this is like a big city, it's that does the income, is it diversified, and have too many people put money into the city expecting values to go up in order to justify return. And California in the last few years has really seen that affected. And I think that's largely why San Francisco is taking such a big beating on top of the tech stocks falling, right? Believe it or not, secondary cities in the United States performed better than some of the primary cities like San Francisco during 08-09. I don't know how far things are going to fall this time around. And cities that used to be secondary cities are now primary cities. But if you look at places like Denver, there's this little orange line here during the Great Recession. It barely moved, right? It did the slight blip, and largely because no one paid attention to Denver and they had pretty diversified industries. So in terms of the amount of risk that you were taking, it was pretty minimal because no one else was paying attention. And those are the places that are actually the safest. Is where is everyone dumping their money? Go in the opposite direction, follow the data. Don't listen to what the news tell you. Maybe listen to what other investors are talking about. That's typically how I would understand how to protect yourself from downside risk in terms of these markets. So volatility, though, it also tends to hit boom cities the most and vacation markets. So Phoenix, for example, is taking quite a beating. It's probably going to keep taking a beating, even though everyone said, yes, Phoenix, we're diversified this time. We're better than we were in 08-09. It hasn't played out that way, at least where prices are currently headed. In terms of vacation markets, Las Vegas was the first city to start seeing rent declines back in 2022. And so Vegas has the double problem of being pumped up by California money during the pandemic because, as you know, people ran out of houses to buy, couldn't afford in California. They didn't want to take risks and go out further east. And so they went about as far as they needed to, which is one state over, which is why Phoenix, Las Vegas, these cities boomed way harder than the ones on the East Coast, largely because it was closer to that main financial center of California. And now that it's getting affected, that tide is receding and they're getting hit harder than most cities. On top of that, Las Vegas is a party city, and when the money gets cut off, you stop ordering bottle service, and you might still go to the club. You're just not partying like you used to, right? So that's how we at least analyze risk on the hedge fund side. And so where are the companies that I am doing data consulting looking at? Where are these opportunity markets that we see on the horizon? Well, Florida. We are scaling up in Florida, and it's kind of weird because you would think that it's a vacation market, but cities like Tampa and Jacksonville are actually less dependent on hospitality. They're quite finance heavy. And especially, for example, Jacksonville is a logistics hub. A lot of trains run through there, and it's right on the ocean, right? So anytime things get delivered, it tends to go through there as a point of entry, just because it's cheaper than Miami as a point of entry, and it's closer inland, and it has less risk for hurricanes and flooding. So, Tampa is a huge source for New York financial hubs and their satellite offices. If you're in Miami or Orlando, though, that's definitely much higher risk. But Florida has dominated rent growth throughout the pandemic. As you can see here, I listed it, but the prices didn't increase as much as other places. So, for example, if you look at Austin, the one everyone's talking about, same thing with Dallas, like the Texas cities, rent grew slower. And that's largely because of the difference between supply and demand. Texas is really easy to build. Florida, it's not actually. Everyone thinks Florida has loose laws when it comes to landlording. They tend to do, but the problem is Florida gets hit with hurricanes constantly. So the cost of construction and the permitting required is extremely high. So building new housing is quite difficult in Florida because any new homes have to hit the standard for hurricane resistance, whereas older homes get grandfathered in, but those are the ones that get washed out very quickly, right? And so those are the things you have to consider. But this is a classic case of demand and supply. Texas, all we did was kept expanding, right? You ran out of space here. Well, we buy the farmland a bit further north, and then we just build a whole new community out there. And so for that reason, that's the best explanation for supply versus demand and why rent didn't grow as much, even though Texas appreciated more or had more population growth or wage growth or job growth. It just seemed that the supply constraint in Florida was a benefit for investors in terms of rent. And then probably at some point also valuations, because even though the market's starting to decline, as you can see, Miami rent's still kind of going up. You know, it's slightly upticking, whereas Texas is starting to shift downward at this point. And, you know, San Francisco's and Seattle shifting downward, but it just seems like the momentum's starting to keep carrying them. Other markets, college towns, believe it or not, are killing it right now. College towns are the only cities on average that are still increasing in rent. They took a beating, obviously, when all the schools shut down for the pandemic. But now that the market's starting to turn, most of the people who got laid off, they were white collar employees, right? They were professionals that likely had degrees working in tech. Now the layoffs are in finance. Where are they going to go next? They're not going to go straight back to working at McDonald's, right? Even though McDonald's is trying to hire people still left and right, or Amazon warehouses, they're going back and getting their MBA. They're going to get that MS. They want to get promoted when the market is down, so that by the time they finish the degree, they're going to be ready to take on, you know, whatever's next. And so what we see in the data is that college towns are outperforming the average American market. Affordable housing. So we did a project for affordable housing and earlier this year. The thing that blew my mind was just that you can actually have better returns on affordable housing than normal market rate housing. So that house, that apartment complex in that picture is actually an apartment complex. That's affordable housing in Austin. The developer we're partnering with is the biggest developer in Austin. And he builds like one of these a year, which is like a brand new 300 unit affordable housing project. You're always going to have tenants. That's the biggest perk. And you can do Section 8 or vouchers. And that's simply what most people think of when you think of affordable housing. That's not what this is. This is tax credit affordable housing. So what the government has said is if you keep half of your tenants below the threshold for low income, you pay no property taxes in Austin, Texas. So when we took that tax credit out, our NOI was actually higher because of that, right? Our income is valued the same as a normal multifamily building, but you now have the backing of the American and local government. So this thing got streamlined right through the development process. We got tax credits. There's a fixed 4.7% interest rate on this for 5 years for a brand new construction building. It's almost always variable rate, right? And so when I looked at the math, I was like, how's this outperforming? Why doesn't everyone do this? Well, they only accept 40% of applications for new developments a year through the HUD program, right? And so that's why it's artificially capped more or less, because we don't give that much money for affordable housing. And it's also why they only do 1 or 2 a year. Otherwise, everyone would be going after this. There's a lot of applicants because financially, you are protected from your downside. It's not like a surprise that will ever worry you. Like, for example, if you invested in Texas in the last 2 years, you're dreading that new property tax appraisal because you know it's going to shank you and you're going to have to pay 2.2%, which is one of the highest in the country. And that deterred a lot of people or brought them to cash flow negative because they didn't project that it was going to hit them so hard. But now with, you know, with the tax credit, that's no longer a surprise. And then you have guaranteed income. And believe it or not, it's not as bad to manage as you would think when it comes to normal Section 8. For example, in Austin, low income is 60% or below the area minimum income. Austin's median income is $110,000. So if you make 65 grand or less, you're considered low income in Austin now. That's teachers, that's policemen, that's a lot of the middle class, basically. So it's not what everyone usually thinks of when it comes to affordable housing, of, you know, garbage fires and high crime. It's just a lot of middle class people, and then you get a huge tax credit on top of it. So highly recommend you guys take a look into affordable housing, or if you're interested in doing good in the world instead of just raising rent on everyone, feel free to reach out to me on future projects. Casual plug. And of course, as Dennis was mentioning earlier, the Midwest is not crushing it, but they're not collapsing. So rent and valuations did not explode in the pandemic. These are, if you compare this to stocks, these are low beta cities, right? So you don't have much volatility. They kind of just go up in one direction forever, right? And so that's Cincinnati, Cleveland, Indianapolis, Kansas City, St. Louis, Virginia Beach. There's a couple of them, obviously, but once you go East Coast and Midwest, they didn't get as much attention because they didn't have that California IPO money being dumped into Las Vegas, et cetera. So the further east you are, the safer your current valuations are. Obviously, that's subject to change if the market totally shifts. But as we know, rent doesn't fall. And why is that the case? Because everyone needs a place to live. You get foreclosed on, you're still going to rent, right? And it's tied to income. So as long as income and those jobs stay safe, which, I mean, until we get and start seeing a lot of unemployment, it seems like people are going to be able to support the house either through rent or through their own income. So it's a hard cycle to get out of, other than by providing too much supply. Prices might fall, but I don't really see that with rent, which is, in my opinion, the most important metric you should be looking at if you are an investor who cares about cash flow. So this is my conclusion. This is created by Dali. I'm not going to read over the rest of it. It's an ever-changing landscape, though, and hopefully this gives you guys an idea for what to do for the next year and where some of these larger funds are headed towards. And if you guys have any other questions, let me know now. So.
This is some really good content. Is there a link to the slides as well after this meeting?
Yes, it is actually tome.app. So that is the, I'm going to drop the link here and I'll drop it on the group chat afterwards. You guys can take a look at the chart, but we also keep it on our newsletter. So if you're on settlerealestate.com at all, you're going to be able to see, I've sent these out in our newsletters a couple of times over the last year. I dropped the link in the Zoom chat, and then I'm going to pop it on the Facebook. Tome.app, you guys should actually just play around with it. I think people are going to appreciate how much effort it is to do any work. In fact, you should use my referral link. I'm going to drop this here. If you guys want to sign up, you click a button and it makes 9 slides for you based on the topic of the presentation you want. Then you go and you change it as much as you need to, and then you can adapt the text and the images to however you need it to. But yeah, I just dropped it in the chat. Hopefully that works out for you. Mark Young, what do you know about property insurance in Florida and operating in severe weather? Okay. So property insurance is, yeah, our premiums are going up. That's pretty much the best way I can describe it. Hurricane and flood insurance they all went up by, I think like 50% this year, at least for our building. I don't know what everyone else got hit with. We're 30 minutes inland of the water too. So it's not like we were at risk. The 2 hurricanes this year, we did get hit by, the weather, but other than a few wet windows, nothing really happened to our buildings, right? And so, but even us, we got a higher premium that we had to pay. But if you're on the coast right now and you're an older building, I gotta tell you, it's a hard time. They've also stopped funding, or they stopped getting out policies to homes in Florida on the coast that have roofs that are older than 15 years old. There was a insurance company that did a little bit of fraudulent work, and then they got canned. So the government's going after them. But a bunch of these homes, when they try to get the payout for the premiums, basically sent the company into bankruptcy. And so a lot of the other smaller insurance companies are either leaving Florida or they're saying, if it's older than 15 years old, I'm not going to give you coverage for hurricane.
Is it still the FEMA maps that we should be using to assess like potential flood risk?
Yeah. FEMA. If you are trying to buy a property and you just get a quote from your insurance broker in Florida, they're going to tell you very quickly, hey, this doesn't even fit our parameter and we're not even going to cover this. So I would recommend that. And then also asking for the age of the roof as quickly as you can while you're doing your due diligence, so you don't waste everyone's time.
Gotcha.
Tracy said, what is your take on commercial assets, industrial storage, office space, et cetera, on this topic? I didn't include this, but if I could include a map of the risk profile that you would have, on one side, the safest asset is multifamily real estate. That's why everyone's dumping money in there. The valuations might fall, but the income is the safest. All right. So that's what matters, in my opinion. If you bought correctly, you're looking just at how much revenue can I produce and can I use this to survive onto the other side. So multifamily is the safest. On this other side is hospitality. If you're in hotels, if you're in Airbnbs, that's probably the most cyclical. Even in Austin, I'm talking to people right now who are saying, yeah, my revenue is probably going to be 25% less than last year. That doesn't happen in multifamily unless you have COVID happen and you are downtown San Francisco, right? And so if you are dependent on the strategy of cash flowing as an Airbnb, it's going to be a tough time for you once more funding gets cut. Right now, actually, believe it or not, demand is still decently high. I think we have 6% more nights booked than we did last year over year. But we've gone and increased supply by 30%. So a lot of the people who aren't making the targeted underwriting number that they originally planned on, it's because supply grew at such a large rate that the average number of homes booked is actually down. So revenue is down because so many new people started Airbnbs in the last year, even though they're booking more nights technically. So I think that's really going to bite them in the butt once people realize, hey, we're actually out of money and we can't keep spending. And that, I think, is going to happen closer to Q3 or Q4. 2024 is also likely to be a red year, and 2025 is when we're all predicting that things are going to come back. Of course, it's really hard to project into the future. Take all of this with a grain of salt. This is just how we're modeling amount of money that we're putting into the markets. Now, that being said, I didn't answer the full question. Multifamily, safest, and then hospitality is the riskiest. Commercial, it's right in the middle because it's not like shelter. If a business goes bankrupt, it sucks, but it's not necessarily required. They might just downsize, fire people, and that is more likely than, say, someone deciding I don't need a place to live anymore, right? And so your revenue for commercial buildings is going to be somewhere in the middle, and it depends on the type of asset. But what's interesting is I've talked to a lot of people about this in a mastermind group that I'm part of, and from advice I've taken from people who are much smarter, more experienced than me, who've done this for decades. If multifamily is the safest, this is small retail strip mall and flex space. And it's because anyone with a business can afford $1,000, $1,500 in rent. And so if you have a popular retail center, for example, and by popular, I mean like at least 20,000 cars passing by a day, that strip center is likely to survive pretty much anything, because if one person comes out of it, you can find a new tenant to replace them, because those tends to be the lifeblood for a lot of individuals, the same way shelter is. You can downgrade from a huge office, but you'd be shuttling a lot of those leftovers maybe to a smaller space. Even for retail, obviously don't pick anything that's retail shopping or clothing. You would much rather be safer with a retail space that has a lot of service industry, such as restaurant, laundromat, things that people need to show up for. And so those tend to be the businesses that will survive any downturns, which I never realized was a thing. But talking to them, they said like, yeah, these tend to surprisingly do really well, as long as it's, of course, it's popular and you can cut it up into spaces that's affordable for individuals. Let's see. Pierre Fontecha, I think the new trend in light industrial dev is converting small portions into residential. My firm is pivoting towards that this year. Yeah, honestly, to be fair, that's not a new trend. Everything in the last 2 years has been some sort of, how do I turn this building into more residential space, right? You saw a lot of warehouses being turned into high-end, tall ceiling residential apartments. You saw old schools being turned into high-end residential, like any sort of ability to make residential. Maybe you're forced into doing mixed use on the first floor because it's commercially zoned. Every sort of product has been trying to be transitioned into residential because that's the maximum way to like get a good valuation off of it. Because you go from, for example, if you take hospitality, you can have like an 8% cap rate, right? If you have a hotel, it's like 7-8% cap rate. In that same city, your cap rate for an apartment complex, 4%, right? And so that's the ultimate form of value add for most people, is how do I make apartments out of this? And that has been what everyone's been doing for the last 2 years, to the point that cities are now saying, hey, if you're going to convert this, you need to add some sort of retail or like storefront space so it feels less like all apartments, so that, at least that's my experience in Austin and Chicago. Steve, with higher interest rates, we really do see acquisition activity slow down. What's the big boy investors that are doing these days to keep these investment momentums going, or they are doing the same to stay put? Okay, with the higher interest rates, what is happening? People are putting more money down. That's really it. No matter how big you go, ideally you've took out a line of credit before all the rates started increasing. But a lot of them took floating rates because they thought, oh, these low rates are going to stay around for a while. I'll have time to refinance. So, for example, one of the companies that I consult for, they own like 10,000 single family homes. The way their interest rate works is that it's kind of like an inventory loan, right? And so each new home gets kind of like a new rate, even though, and then you take the amortized version of that at each strike point. I thought that was an interesting way to do it. But they said this was the cheapest way to get the best interest rates. But now it's starting to bite themselves in the butt because they have to refi out of that, right? So everything depends on what loan you already had. But if you're doing new acquisitions, a lot of them are just putting more money down to counteract the fact that you don't have the proceeds anymore. If you are in a commercial space, right, it's net operating income divided by your debt service. That's your DSCR. There's typically a requirement that you have 1.25 or higher. And the problem is the debt service is increasing much faster than people can increase their net operating incomes. And so because of that, right now, multifamily, if you're doing an agency loan, I'm seeing a lot of people try to raise money for deals at 40% down or 60% LTV, right? A year ago, this was still 75% LTV or 25% down. It's probably going to keep going up, and it'll probably cap out at some point in the next quarter or two, which is when most people are saying the Fed is going to stop increasing interest rates. But if that's the case, then we could easily see people going 60% down or 40% LTV, which sounds terrible. You might as well not get a loan at that point. But if you can get the returns from that, some people still do. You never know. But, if you follow Brandon Turner, for example, he just raised a fund of 30 million bucks. His average LTV is 45 to 55%. So he's averaging 50% down on his purchases, and somehow he's still getting people, 8% cash on cash and return or preferred return. So it's not cash on cash yet. At some point it hits 8% cash on cash. And then, that's the structure that he's trying to build. Tracy, host Nation Unite. Thank you. Okay. Pierre, you're right. For reference, in Tukwila, Washington, one of our newest projects is in that frame of investment architecture firm, also licensed RE. Gotcha. Well, Pierre is a licensed architecture firm. Feel free to reach out to him if you guys need any architecture assistance. And then let me see if I have any other comments here. Architecture firm, feel free to reach out to him if you guys need. Okay.
Well, can I ask a question? This is Kong. Basically, I was curious what you think about like those hot market like, New York or San Francisco. Do you think the price gonna continue to go down or it's level out? Because, I think it mainly price didn't go up. Well, two reasons, right? Like tech stock went down, got hit quite a bit. And then I can see like people job wise, people still making good money. They didn't get hit hard yet. Mainly they hold off the purchase because of the interest rate, right? But then at the same time, the supply, I don't know, didn't go up that much, still pretty low inventory. So just curious what your thought is. I mean, everyone's trying to figure out like when it's gonna bottom out.
It's going to keep going down this year, but it's going to go up until summer. I know it's like an answer you don't want to hear, but it's seasonality. You're going to see prices go back up again. You're going to think the market's recovering likely, because that's what it does every year in January when everyone's most excited to start buying houses again. And it's going to keep climbing until it hits summer. The problem is this year, it's not going to go as much as it did in the last 2 years. Once people start realizing, oh, I can only borrow half as much as I could 2 years ago, and then they're going to start backing out of the market. And so you're going to get a lot less demand, but you're right. We still are an all-time low supply. And that's why I think prices aren't going to wholesale collapse like 08, 09, right? It's going to fall 5, at most really 10%. And until tech stocks recover, right? I don't think people are going to do that. Like San Francisco's not going to have as much spending money. And then on top of that as well, the amount of people who are leaving California is not helping it, right? The amount of high income individuals who used to set the prices, they're starting to transition out. And that's also why rent has not gone up the same way it has in every other major market. If you look at San Francisco, rent's up like 9%. New York is up like 30% since the pandemic, right? So if you look at the numbers alone, San Francisco is losing too many high income earners to justify like pricing pressure going up again. Also, if anybody wants, last second, this property is going for sale. It's not mine. Someone in the group sent it my way, and was supposed to give it to somebody else to handle, but they're backing out of it. It is a property in Oakland, and I believe they're selling it for 900 grand. It's a triplex. I don't know what the situation is anymore, but basically the seller is going to get foreclosed on at some point today or tomorrow. And they're willing to let it go for 900,000 just to get themselves out of foreclosure. No, it's not this one. This one? Here we go. This is the house. Can everyone see my screen, or am I sharing the wrong screen?
We can see it.
Okay, awesome. Yeah, this is the house. They remodeled it. They're willing to let it go for 900,000. It's a sub 2 deal. So basically you can take over the property for 120 grand. The seller is still on the loan, so you don't have to qualify for it. And then you hold title. So if you're curious, I can help connect you. I just don't touch anything California residential. But they spent a lot of work updating and remodeling it into an Airbnb. It's 3 units, 2,700 square feet, huge lot in the back, but it's a rough neighborhood, I think. Yeah, 36th Street. Someone was telling me this is a rough area. I don't know. I don't buy in California. So this is for everyone else to decide. I think we have like 1 day left. So you got to like walk it and then throw down 100 grand. But it's like a 5.8% interest rate, which is kind of cool. And you're apparently appraised for 1.4 million in April before they spent 50K in renovations. I talked to a broker. They said it was like 30K maybe, but they spent money updating it. And then it appraised for 1.4 in April 2022. So if that gives you an idea of what prices are going for, it's dropped like 20% right now in Oakland. All right, this literally tracks with the graph that I showed earlier. Oakland is D class, so valuations fall the hardest, and it's also in San Francisco, so you're taking, you got to take that into account as well, right? So this thing just really tanked in value. So if you're an Oakland investor right now, I'd be very cautious. I see it keep falling possibly for another year. Again, if you're D class, that thing just tanks harder in value. Let's see. Yeah, Pierre. Yeah, if you guys have any light rails being built, now's a good time to buy stuff, chase those light rail stations, because the market will probably be back by 2025, and then all of a sudden everyone's gonna be paying attention to buying real estate again. Honestly, now is still a pretty good time to buy, in my opinion. If you go in, knock their door and say, give me 20% off, interest rates are down like a whole percent from the peak last year. And this is like a really good period of time to buy something 20, 30% off. Like if this is actually worth 1.1 million and it priced for 1.4, it's 20% off already from the value falling. And then they're willing to sell it for 900 grand, which means you've knocked off another 200 grand off the value. So that's another 20% below what the value should be, right? So to me, it's like, I don't think the value is going to fall another 20%, because then we'd be seeing like the same collapse that we did in 08, 09. But this is a prime example of the data that I was showing earlier, which was don't buy D class at the height of the market, and make sure you invest in a market that is on the up, not on the down. I know a lot of people bought in Oakland because it's the closest thing they could buy since they lived in San Francisco, but there's just a lot of risks to buying in a market where people are leaving, especially high income earners. Let's see, that wastes devs money. They're looking for the light rail. Yeah, I'll hit you up later for that shoddy strip mall. Tenzin said, is it the hood Oakland? I might be able to check it out in 2 weeks or 1 month. No, Tenzing, this is going up for foreclosure soon. So if you want it, you got to reach out, like, I don't know, in the next day or two before it hits the auction block. Otherwise, you have no chance of picking it up. Steve J, are you single? Yeah, thanks. Michael Huang, is there a generalized class for cities? Where do you guys go to learn about property classes for investments? Well, fun fact, we have a whole Notion dedicated towards that. So we've been building this for a while to help people analyze markets. And if you want, happy to send you that link later. But for example, we have the real estate investing guide. So if you're interested in how to pick a market or expanding into specific markets, where I drew these funky maps about where I think the quality of the neighborhood is, then that's a generalized class for, I guess, investigating different cities that you might want to invest in. If you want to learn about property classes for investments, the best way to tell is what type of coffee is near there. You can usually kind of figure it out. I've said this for a while. If you're A class, it's probably going to have craft coffees and breweries in the area. If it's B class, it'll have Starbucks. Class C is like McDonald's and Dunkin'. And in class D, likely has no coffee because they don't really have jobs. So no one's waking up early and needing coffee. So that's just like a quick benchmark way. The other way is actually to go deep and do your actual analysis. So for example, this is a website I use a lot, citydata.com. If I looked in on Oakland, California, oops, did not mean to type in Oakland A. If you look at the city data map, what they do is they actually break it out into household incomes for you. So you can go in and see the quality of the neighborhood that you're in. So yeah, as you can see, Oakland, most of these places are low income, 37K, 21. It's probably high crime as well. But the further north you go, like 160K, the nicer it gets. That property area, 68 grand. So it's probably somewhere right in the middle in terms of high or low income. Actually, 68 grand is probably low income for Bay Area. So, those are the things that I would look at if you're trying to compare good neighborhoods versus bad quality of the class. Like, it's very obvious, like Piedmont and these areas are much higher income. And then that the closer and the more Oaklandy you are, the rougher it gets. There's another button here that says percent change since 2K. So this is a way to tell where the path of progress has been since the year 2000. Obviously, all of the Bay Area has seen a lot of growth, but you can kind of see the places where it is going and the places that it isn't. So that might be a fun way for you to check. Like here's Vallejo. Most of that growth has been in this downtown area. There's been some on the outskirts, right? So, it's a way to check the path of progress for certain cities. I use this in Chicago and Austin, but it's hard because, for example, in Austin, it goes in every direction. So you don't really have like an idea for where actual path of progress is. Michael Huang, is this okay? Pierre, thanks for awesome content. So hopefully that helps, Michael. Those are all the things we try to give people for information. Pierre, a lot of Bay Area people are moving to Seattle. Do you think it's a good idea to study how the Bay Area filled out through time? Maybe that general pattern can be applied to Puget Sound region as a base strategy and talking point. Maybe it's a little hard to say, take one city and use that as a general pattern across every city. If you had multiple cities that had that effect, maybe. Like, I wouldn't just use the Bay Area to compare it to Seattle. I would take Seattle, Bay Area, Austin, like the big major tech cities, and then use that as a pattern for other future tech cities that people are going to consider tech cities, right? Pierre said seattleandprogress.com to track patterns. Yeah, I haven't used it before. It's probably a good idea. All right, so we're coming up on the hour. If anyone else has questions, happy to take them. Otherwise, I think that's all the warnings I can give for this year going forward. The patterns are probably going to keep repeating, but also the closer we are to the bottom, the better time it is to start transitioning into the other assets that I said were riskier. So, for example, if you bought D or C class in 2011, you would see a much higher return overall compared to people who only bought Class A. But the people who bought Class A at the peak, they fell the least in value. So if they decide to sell at any point, they'll come out the other side and then buy a bunch of rough neighborhoods. Those are the ones that they can get the biggest discounts on, right? It's why I showed you the one in Oakland. The rougher the area, the more picky people are when the market goes south. So, that home that had that weird extension that didn't get a permit for, someone would have just snatched it up back in, 2 years ago, but now everyone's being pickier. They're like, go back and do the work, or you got to knock off 30%, right? So if you want to get a cheap discount, Class C, Class D is probably the best place to go. But now's also a really good time to pick up some Class A. But if you think now is the bottom of the market and we're going to come up in the future, in the next year or so, go for it, buy Class D. But if you think things are going to keep falling, I would say follow the trend that has kind of existed throughout the history of most investments, at least the ones that I can show through data, and figure out a way to protect yourself from that downside risk. That's my general advice. But also, this actually isn't real estate advice. You guys should all make your own decision. All investments come with risk, and I thank you all for a good night. So,
thanks, Nelson.